Good morning and welcome to the Homestead CPA. My name's Dan Snyder. If you're new to the channel, welcome. If you're a returning visitor, welcome back. Today we're going to be covering part 7 of a 15-part series on accounting, tax, and legal issues for homesteaders. Today's topic is transportation expenses. Now, if you haven't been watching any of the other videos, that's fine. Each of these videos is a standalone video and you can watch them in any order that you would care to. Today is also Friday, the 27th of December, so late Merry Christmas to all of you and an early Happy New Year. At this time of year, the number one call I get is, Dan, should I buy a new blank? And you can fill in the blank. But since today's topic is transportation expenses, we're going to use the term truck. Dan, should I buy a new truck for tax purposes? And so that is a discussion that we have because many people don't know how transportation expenses, how the deduction for those works, especially when we're talking about automobiles and trucks. So I just wanted to go through that with you today. There's two main ways that expenses for transportation can be deducted. One, which is the standard way, is to take a cents per business mile deduction for each mile of business mileage traveled. Now, in 2024, it was 67 cents per mile. In 2025, it's going up to 70 cents per mile. This is adjusted each year, and these adjustments are based upon fuel prices, insurance prices, auto prices, and as we all know, those are all going up, as is the cost per mile. Now, you might say, well, I got a 10-year-old car, it works just fine, it's not costing me that much. That's fine. You still get the same 70 cents per mile, whether you're driving a brand new vehicle or a 10-year-old vehicle. The other option is to take a percentage of your operating expenses. Now, the first thing that you have to understand about that option is that you have to have a vehicle that you use for more than 50% of it as business. So if you don't travel more than 50% of your transportation, your mileage, more than 50%, you have no choice. You have to use cents per mile. That can actually be an advantage, and we'll talk about that later. Now, regardless of the way that you choose, cents per mile or a percentage of actual expenses, you have to keep track of your total miles, your total business miles, and then, of course, everything else. If you do not track the total miles, and you do this by recording on January the 1st, what was the mileage on your odometer, and on December 31st, what was the mileage on your odometer, the IRS is going to disallow the deduction. Why? Because you can't prove without that starting and stopping that the vehicle went anywhere. So even if you said, well, I'm only claiming 400 miles, yes, but you can't prove that the vehicle actually went 400 miles. So that's the first thing. The second thing is that, and actually I suppose this maybe even should have been the first thing, is that this is the first deduction that the IRS is going to disallow when they audit your return. They're going to check your deposits, see how much income that you made, and then when they go to expenses, the first one they're going to is transportation. And the reason they do that is they know that 99% of the people don't follow the rules. The rules require you to keep a contemporaneous, that means at the time, record of your business mileage. And in the old days, you may have seen your parents with a little book in their car, which they kept, and every time they went somewhere, they wrote down the mileage, how far they went, where they went, and then at the end of the year, they'd hand that to their tax return preparer. Nowadays, we've got it a little easier because there's 100 apps to keep track of your mileage. The biggest excuse that people give me for not having mileage is they forgot to turn the app on. I'm sorry, we can't do everything for you. You've got to remember to turn the app on. But if you do, when you begin the app, the first thing it's going to ask you is, what is your mileage? Take a picture of the mileage that's on your odometer with your phone. Enter that number into the app. That way you've got confirmation, at least when you started using the app, how many miles you have. And then the app will keep track of your mileage And then at December 31st, you can do a printout, or even during the year, you can do a printout to an Excel spreadsheet, and you've got a record of all your miles and your business miles. So that part of it is easier, but I promise you that's the hardest part. Even though it's easy, it's hard because it's hard to remember to do it. So do it because it's a very valuable deduction. Keep in mind, if you're paying income tax at a rate of 22% and you're paying Social Security tax at a rate of 14%, that's a total tax rate of 36%. So if you drove 10,000 miles during the year, of which that were business miles, at 70 cents per mile, that's $7,000 worth of deduction. And at 36%, that's a roughly $2,500, $2,800 tax deduction. So it's very valuable. Also, depending upon what kind of vehicle you have, that may or may not, generally may exceed the amount of money you actually spent out of pocket on operating the vehicle. So what are these expenses designed to cover? The cents per mile. It doesn't cover everything, but it covers anything having to do with the operation of the vehicle. So fuel, oil changes, tires, insurance, repairs, anything that is required to make that vehicle legally operative on the road and traveling down the road. That's what that cents per mile covers. What doesn't it cover? It doesn't cover parking. It doesn't cover tolls. It doesn't cover interest if you've got an auto loan. So there's some things that aren't covered that you can take in addition to the cents per mile. Be sure to talk to your tax advisor about what he wants and the form that he wants that in. Okay, so which one should I choose? Well, as I mentioned earlier, if you have less than half of your mileage as business miles, you don't have a choice. You will use the cents per mile. But let's say that you have two vehicles and one vehicle is entirely used for business. Then that vehicle, you can take all of the expenses that you paid for your gas, for your oil, for your tires, for your insurance, and you can take a deduction for the actual cost of the vehicle through the mechanism known as depreciation, which we're going to be talking about in a couple of videos from now. Depreciation is a deduction that reflects a reduction of the value of the vehicle due to the fact that you've been using it. And this is, there are a lot of different rules with respect to this, but one of them is if the vehicle qualifies, you can actually take a tax deduction for the entire vehicle in the first year. Oh, wow, that's great. Maybe yes, maybe no. That is an election that you can make. And once again, it's going to be one that you're going to want to talk to your tax advisor about. So why do people call me now? Well, they call me now because if you're going to buy the vehicle, if you buy it on December 31st, all of your tax deductions are associated with the year 2024. If we buy it on January 1st, 2025, now the tax deductions are associated with the following tax year. Why is that important? Well, it may be that in 2024, you're having an off year. You're not making as much income. You don't need the tax deduction this year, and you may wish to defer it to next year, to 2025, because you think you're going to do much better next year. Vice versa. You could have been, let's say you're in the real estate sales business and you just closed on a massive piece of real estate and you've got a great commission. Well, you want that deduction this year because you know that the odds of having that same amount of income next year is going to be pretty low. All of these decisions could be made at the time of the preparation of the tax return. This is not cooking the books. This is not cheating. This is a choice that you have that you can make as to when and how to take the deductions for transportation. And assuming you make that choice, our job as your tax advisors is not to tell you what to do. Our job is to tell you what the impact of that is. Obviously, if you write a vehicle that you're going to pay for the next 6-7 years, pay that off over that period of time. If you take a deduction for all of it this year, in those future years, you're still going to be making car payments, but you're not going to be getting any tax deductions. So your deductions aren't going to match your outflows. This may not be beneficial to you. You might want to try and have those match or be more closely related. These are choices that you get to make. So your tax advisor can be of great help to you. how would you feel if you took a deduction for something and you were in the zero tax rate for income taxes and all you saved was the 14% self-employment tax? That may be fine. That may be what you're trying to achieve. But you may think, well, no, I'd rather wait till next year and get an income tax deduction for it also. So these are the decisions that your tax advisor is going to help you identify to make sure that you're getting the best bang for your buck for any sort of deductions. The last thing that I want to point out, the difference between those two, has to do with the disposal of the vehicle. If you have been using cents per mile, and that's it, when you sell the vehicle, it's the end of it, the day you sold it for less than you pay for it, you're not going to have a loss, but you will have a gain, or you probably break even, So you're not going to have a gain or loss when you dispose of that vehicle. If you've been taking if you've been taking percentage and you've depreciated the vehicle, now you can potentially have a gain when you sell the vehicle. Now that can be offset if you replace it. So let's say that you had a vehicle and you paid $45,000 for it, you wrote it all off, and this year you sell it for $10,000, well, you have a $10,000 gain that is taxable. But if you sell that vehicle, buy a new vehicle, well, now we may have a new set of tax deductions on the new vehicle, which can help offset the income that you're going to generate on the old vehicle. And this is true whether you sell the vehicle for cash or whether you trade it in. If you trade it in, there's going to be trade-in value on that sales sheet, and that's going to be the amount of the sale price of your vehicle that you're trading in. That's a third-party amount, and so that's now an important number. It didn't used to be that big of a number, but it is today. So it is important to notice that. So possible risk of gain on the sale of the item, especially if you're close to retirement, and this is going to be the last vehicle that you use for business, versus possibly a lower amount of deduction. So what's the trade-off? Typically, I tell people, if your vehicle is going to cost you, and it doesn't matter whether it's new or used, but if your vehicle is going to cost you more than $30,000 and your mileage is going to be less than 20,000 miles a year, then you are likely to benefit from taking a percentage of actual expenses if more than 50% of the use of the vehicle is for business. If the vehicle is less than $40,000 or you're driving it more than 30,000 miles, then it is likely to be more beneficial to take cents per mile. You make a choice when you have the car new to you. So when I acquire the vehicle, that's when I make my choice that year. Am I going to take cents per mile, or am I going to take a percentage of actual expenses? And I'm stuck with that choice until I get my next vehicle. So with that, I wanted to thank you all for being here. And remember, even Jesus paid taxes.